Katie, thank you so much for joining us here at RiskMinds. You've been talking this week a lot about regulation. Where are we at with the Basel rules and what impact are they having and what do you expect them to have?
Right. So we have the final rules. I think the panel I was in yesterday, the moderator, he said, oh, this is quite noteworthy. It's been a year since the package has been published and has been out there. So I'll say that, but then again, we do have the final market risk rules where we're still waiting for a little bit to come through. But I would say, by and large, we're very much there, which is a pretty big deal because that took a long time. The negotiation was pretty fraught. It was a very difficult package, I think, for the regulators, the policymakers to get through. We do have it. We're at a place where we can see what we think the shape of the frameworks are going to look like across, in reality, all of the different risk types. So credit, counterparty credit, market risk. We're sort of starting to see, at least theoretically, academically, what we think that picture is going to be. I think it's challenging to know exactly in practice what that application will mean for certain business lines, certain asset classes. We have an idea. We know sort of anecdotally through some of the Basel monitoring QIS exercises. We know where some of the pockets of capital are likely to be concentrated. We have an idea where it was a little bit more challenging, where a little bit more uncertainty in terms of estimating what that impact is going to look like. But we're at a good place, I think, to start to see that picture coming into focus, which is quite interesting. So, yeah.
But you've kind of got to predict the future in a way, haven't you? And there are things happening now that will be impacted. So it's a tricky position to be in.
I think we need to be careful, and I think that is maybe the temptation, is to say right now, what is the world going to look like in 2022, 2023, when these rules get transposed, when they are actually live and binding requirements. I think that's really, it's tempting, but it's also a high-risk strategy because we're at RiskMinds. Let's talk about it. I don't think we want to kind of front run all the way to that space yet. I think the strategy that we're trying to employ, and we, I mean my team, I mean the firm, and I think the industry, to be honest, as a whole. I mentioned these Basel monitoring QIS exercises. Those are extremely valuable. So they happen on a semi-annual basis. They allow you to see what do the numbers look like? What do we think these impacts are going to mean? And in some respects, the ease or difficulty of computing a certain figure gives you a lot of insight into the practical things, so the operational feasibility of implementation. So,
you talked there about implementation. What are you expecting in terms of how this, is adopted?
Yeah.
Are you expecting a fully loaded approach, or are you expecting it to be a sort of phase in? And will that differ in different geographies, jurisdictions?
Absolutely. Too? So that, yes, it will. There will be certainly some regulators that decide they want to go early. They want to go with the Basel timeline. They want to go. So, if I can give some examples, because I've been relatively high level now. So I think SACR's standardized approach for counterparty credit risk is a good example. I suppose, what do we call that Basel for? It's certainly part of the rewrite of the capital framework, so we will throw it in that kind of pile. But that's a very good example where the original timeline for implementation, 1 Jan 2019, OSFI, the Canadian supervisor, is following that timeline. So, and they're kind of alone in that space. Other regulators have delayed, they've gone later. Other regulators, so the US is a good example where they have just issued their NPR, Notice of Proposed Rulemaking. I think the timeline for them is mid-2020, I want to say, so a little bit later in terms of timeline. Also, the content of that is slightly different. The level at which you look at the application of the rules is at the counterparty or netting set level rather than at the CSA level, where we have the application of the rules on the European side, or I think that's the original Basel proposal.
If there is that level of complexity that you're describing and so many different approaches in a way, what on earth does that do to the picture for people trying to navigate that?
It makes it hard because it's not only the individual pieces of regulation, so SACR for counterparty credit risk, FRTB for market risk, credit risk, both standardized and advanced. So it's not only the pieces individually in their own silos, but it's the interaction across those different pieces. So a really good example is CVA, the new CVA rules, and then the interaction between those rules and margining. To what extent will the margin of a particular counterparty mean the CVA they have to hold decreases? To what extent will that help or hinder corporates? So a lot of corporates don't have CSAs, they're not posting margins, so they're going to be relatively more impacted by things like the CVA rules. So looking across the piece and seeing things like that, there's a really good question that was raised the other day. FRTB and the new and LIBOR transition, moving away from LIBOR into other benchmarks. So there's a really good question posed there around, okay, well, what does that mean for a certain part of the FRTB framework where reduced set versus full set, and then whether you're going to be able to use a reduced set when actually the benchmark that you were previously using is just not there. So, and we asked the question to the regulator, and they're like, that's a good point. So things like this, that's why I say, I go back to the comment I made, I think it's really dangerous to try to predict the future now, because so much can change in the next 4-5 years, however many years it takes. We just need to kind of watch a little bit and see.
You talk there about going back and communicating with the regulator. What have you seen in terms of the evolution of that relationship? Because, 10 years on from the financial crash, regulation has been a absolute hot topic at all these events because it's been so dominant over the last 10 years. So do you see that relationship changing, evolving, and do you expect regulation to continue at the level it is at the moment, or do you expect to see things calm down, if you like?
So to the first kind of point you're making around the dialogue and the communication we have with the regulators, I have seen, in the past 10 years, I've seen that change a lot. And to be honest, it's become, there's an industry around it. There's an industry around the way that you come together through a trade association as an industry to understand what the impact is for firms, to understand what's a firm-specific point, what's a point for the broader industry, the way you present that to a given regulator, taking into account the particular interest of that jurisdiction or domestic kind of specificity. I've seen that, I would call it an industry, and I've seen it very much mature. And I think, I do think that one of the things, we're seeing a lot more, we've always had the consultation period, but public hearings, having a workshop with the industry, bringing the industry in and asking for, well, can you tell us how this is impact? Because at the end of the day, the regulators, they're not at the coalface of seeing what this is going to be. And I think it takes a broad-minded kind of person or individual to say, actually, that's really interesting, can we have a chat?
And it'll be a lot more productive for it to be collaborative rather than adversarial.
Absolutely, absolutely. I mean, there still obviously is the need to be objective, to take a look, the industry is different. There's the sort of control aspect, the supervisor and the regulator, and that has to be maintained, which I think is right. There's that independence. But I do think that there's a healthy dialogue that's been forming over the last 10 years. So,
do you think the regulators have actually helped in terms of reputation of finance since the crash too?
I do. I think there was a presentation given on Monday by, I think it was Klaus Knott, and just we all remember the original reform, so increasing the quantity and quality of capital from the Basel rules, liquidity, introducing liquidity requirements, leverage ratio. So much has been done. So much has been done over the past 10 years. And I think the earlier point you raised was around where are we now in the cycle? We've been doing this for 10 years. I think we're at a place where we see the end, we see the light at the end of the tunnel, and the Basel Committee has kind of said as much. They've said, okay, it was so hard to get the last Basel package sort of over the line. They got agreement on that. We've seen a full rework of the risk framework, the capital framework, liquidity, leverage. Everything is changing. So let's say we're live in 2022, maybe 2023, 2024. By that time, that will have been 15 years on. I think then it's going to be really interesting. Then, or maybe when we start to see banks anticipating or actually implementing those rules, then we can truly take a step back and say, okay, what does this mean? Where do we see the risk going? And that's where the regulators are thinking now. They're like, we've been spending such a long time regulating, such a long time layering on additional prudential requirements, liquidity requirements. The risk never goes away, it just goes somewhere else. So a lot of their questions now are looking for those pockets of new and emerging kind of activity and making sure that they've got their finger on that pulse to kind of safeguard against it.
So interesting times ahead. Katie, thank you so much for sharing your
thank
insights.
you.
Great
Absolutely.
to talk to you. Thank you.
No problem. Thanks.